Hey everyone, it's Mike and welcome to lesson number 5, point of control as stopping volume. Now this is why I love order flows, because it allows you to see these areas where the market just turns on a dime. And people that are trading on normal bar chart or candlestick chart don't understand this. They're just missing out on this information. And to me, this is really what drew me into order flow, is being able to see how and understand why the markets just turn like this. And point of controls really make it clear for you. So before I begin, a brief disclaimer: this presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. All right, stopping volume. Stopping volume occurs when large volume comes in to stop a move. It's nothing fancy. And, sometimes I see these people coming up with these indicators. Oh, the order flow, algo volume, algo plus thing. And if you just understood, if you just looked at the order flow, if you just put up a volume footprint chart, you can see this. And it's very clear with point of controls, because point of controls are going to be at the extreme. And it's not limited to a large passive bid or large passive offer. Stopping volume often exhibits aggressive traders getting hit on their bids or lifted on their offers. What I mean by that is when you have aggressive traders come in and bid the market up, then the next thing they know that they're bidding, that they're become the passive buyers, and then aggressive sellers coming to hit those bids, just as aggressive sellers are moving this market lower. Everyone's coming in. They're all, I got the market's going lower. I got to sell. I got to get out of my position. I don't care. Just get me out. And then, they hit the bids. Next thing they know, there's no more bids. They become the offer. They become the passive seller. So, but Mike, you're probably thinking, you said aggressive traders only buy or sell at the market. Yeah. But again, think of it, right? If you're a big aggressive buyer and you want to buy 300 lots at 7, there's only 160 lots on the bid. You enter order to buy 300 at 7. You're filled on 160, but you're a 7 bid for 140 lots. So what happens oftentimes with stopping volume is before 8 can trade, right? The market was 6, 7, but you just turned it 7 bid. It's now 7 bid at 8. Someone comes in and sells all your 7 bid. Now the market is 7 offer, and other sellers have come in, and the market starts moving down. It's Newton's third law of motion just took place. An equal and opposite reaction came into the market. And oftentimes, it's easily seen with point of control appearing at the bottom. And this is one of the setups. And what it is point of control at the extreme. Market's selling off, selling off, selling off. Here, it just met with strong passive buying here. 1520. The sellers keep selling this. This is like, gosh, I don't want to sell anymore. I don't know how much this guy's got back there. I sold 1500 at 1 in the morning. 1500 at 1 in the morning is a lot. Look at this stuff. The notional value of that is what's this market? 2660 times 50, 133 times 1520. That size of that order is $200 million right there. At 1 in the morning, that's quite a big piece of paper to sitting in the market, supporting the market. Maybe there was more behind it, and even maybe some more sitting in the order book down there. So if you're trading on a dome, this is what's going to help you, right? If you're seeing point of control right at the bottom, you can react and catch the bounce up, right? Dome traders like to get in front of size. Sometimes you're going to get run over. But if you're seeing that size holding, best way to see it holding is with point of control. You can take advantage of it. Stopping volume is indicative of 2 things. One, in the case of stopping volume at lows, it's institutional buying coming in at low prices to support the market, as well as profit taking. Now, again, I say institutional buying. Doesn't necessarily have to be institutional buying. It's a big order, and generally it's institutional buying. But I said it could be the herd coming in, and everyone just sort of thought the same at the same time, which is rare. But it doesn't necessarily need to be limited to institutional buying. But generally speaking, overwhelming majority is going to be institutional activity. In the case of stopping volume at highs, it's institutional selling coming in with the excess supply at high prices to offer resistance. So what do I mean by institutional buying coming in at the low? There's paper here. It's what's called paper, right? When the floor used to exist, when there's a big order sitting in the market, you'd say, oh, there's paper there, because there's, that's when orders had to be written on paper and run to the market, be sitting in a broker's deck. So people will say, where's the paper? And, broker would tell you, well, there's 2660, there's paper, meaning there's a big order. And the same thing would be this for a sell, right? If there was point of control up at the top, that would tell me that there's resistance selling up there. That's why people like to use the order book. That's why they usually use things as Bookmap, is so they can see that paper in the market. Now, stopping volume, how to recognize it is when the following conditions are met. A new or equal high is made in an uptrend, or new or equal low is made in a downtrend. A reversal bar appears, right? You got to have, it's a reversal setup, so you got to have a trend to reverse, and it's going to reverse on a reversal bar. So it's a red candle at the high or a red candle at a low. Point of control is at or near the top of a red candle, or at or near the bottom of a green candle. Most of the ones that I'm going to show you are point of control at the top. This is stopping volume. This is stopping volume. This is stopping volume. This is what the NinjaTrader 8 version of Order Flows Trader does. It tells you this stopping volume. I call it prominent point of controls, but it's really trying to highlight to me the stopping volume coming into the market. So what's going on here? Market, you had your high, sold off to an area, got some supported buying coming in, comes back up here, 608 on the offer up here. There was more offer here, traded 308, comes back here, 608, even goes bid here, 223. Again, here you had 114, came off a little bit, made another run back here. There's still sellers coming up in here. What's going on? 608 trade there. All the people buying think, we're going back up here to 160 even. It goes bid here, but the sellers had something else on their mind. No, we're not. And they sold into all these bids that were here and sold the market lower. Look at this volume down here, 12, 28, 48. The aggressive seller says, we're not going higher, and just whacked this market. And next thing you know, you just stumbled here, then fell over. Stopping volume leads to market turning points. But please remember, while many turning points exhibit stopping volume, not all stopping areas are turning points, as it may only be temporary as new information flows into the market. What I mean is, just because you have stopping volume doesn't mean it's going to hold forever. There's always new information coming into the market. What was a reason for stopping volume now may not be the reason 5 minutes later. Something, these markets are very dynamic, always changing. I swear, ever since Trump got elected, this news keeps, every day it's like something new. You can't keep up with it, and really the markets are just like that. There's new information always coming into the market. Stopping volume and absorption volume are not the same thing. Absorption can occur anywhere and often occurs in range-bound sideways markets. Stopping volume should occur at ends of moves. Absorption can occur, in a market going sideways. Often that's a sign of absorption. Everyone's happy to trade. All the sellers are happy to sell into the buyers that are happy to buy. Stopping volume is somebody there waiting to buy, willing to step up and say, no, we're not going lower, or we're not going higher. Stopping volume occurs in just about every market and time frame, but markets that are highly volatile and less liquid, it's going to be harder to see. Okay, honestly, it's, if you're trading things like NASDAQ, that move around so fast, it's not going to be as clear as markets with strong institutional participants like interest rates. It's going to appear, I think it appears more often, and it's more cleaner, in markets with more volume as opposed to markets that just jump around all the time. NASDAQ is, jump 5 ticks, in a heartbeat. Whereas bunds or bonds or 10 years are more methodical in their movements. Bunds, like I said, bunds are a fantastic contract to trade. Stopping volume right here. Look at that point of control right on the bottom. Yeah, you got point of control on the top here, point of control here. But this is, to me, this is a go-to trade. It's all, all systems go. Then you just sort of run back into this range. This is a range-bound market. Right here, I don't have point of control. POC, I don't have the I don't have it turned on in this chart. That's why it's not colored red. But I just want to show you what it's going to look like on a normal chart. If you're using just a normal chart, point of control right at the top. Point of control 1 tick off the bottom. Point of control 1 tick off the top. What's going on? Markets rallying. Point of control right at the bottom. What happens? Markets rally, sold off. Buyers stepped in. Second time you touch it, buyer stepped in again. Market went back up. What's going on? Hit this new high. Everyone's coming in. I gotta buy. We're going up to 145.80. What happens? Oh, sorry, 114.58. You know, they're buying up here. They turn the market bid. No, something. No, we're not going higher. Hit those bids. Boom. Look at that. You got imbalances, 4 imbalances in there. Aggressive sellers came into that market. I love it when you get point of control on the extreme, and then you're starting to see imbalances on the way down or imbalances on the way up. You know, just as you see them here. That, to me, that's like golden. That's like, take it to the bank, but you know, to me, that's a high percentage trade. So this concludes lesson number 5. In the next lesson, I'm going to get into the point of control setups. There's going to be 10 setups split up between lessons 6 and 7. And hopefully you could find 1 or 2 of them that you could apply to your trading straight away that can give you some great trading opportunities. So I'll see you guys all on lesson number 5. Bye-bye.